Okay, so hello all. So today we are here to learn the first chapter of fixed income in CFA level 1. Hope it will be very interesting. We will first follow Schwesers in this video. We will go LOS by LOS in depth. So actually, first chapter includes fixed income instrument futures. Okay, so we just have two LOs. These are just very short two readings, and we will be learning about actually the futures of a fixed income security and describe the contents of a bond indenture and contrast affirmative and negative covenants. Okay, so there are only two LOs. Okay, which we have to learn. Okay, now let's deep dive into the content. Actually, what actually the chapter holds. So let's get into the Schwesers first reading. So we are so those who are new to this class, so we will be following Schwesers, we will be following curriculum, and we will be doing practice questions, Schwesers questions, and whatsoever questions we will get, we will try to complete 100% syllabus. So this is Schwesers reading number 47, fixed income instrument futures. So actually you may take a notebook alongside, and you can have notes. So I will consider that you don't know anything. So you are a newborn child actually. You are having a science background, and I will explain each word by word, line by line, and we will cover whole the syllabus. So as said, we just have two LOS. Okay. So first we will be learning about describe the futures of fixed income security. So A consists about futures. What are the futures of fixed income? Okay. So what is actually fixed income? Okay. So fixed income means it's like a more to like you're taking lower risk for a guaranteed returns. That is actually fixed income. Actually, if you are investing your funds in stock market, okay, let's say 10 lakh, there is no guarantee that it will become 10%, 15% in a year. But fixed income acts like I will give you 6 to 8% per year. That's for like sure. Like they guarantee you in insurance schemes, money back schemes, and fixed income types. So NCDs are there, bonds are there. So we will be learning in depth to that. So actually, what does the Schwesers knowledge hold to you? So let's go line by line. What's actually written? So it's written that major type of fixed income instruments include loans, which are private agreements between a borrower and a lender. Okay, so fixed income actually there is a type. It's a type of loan. It's actually include loans. Okay, like I'm giving to the bank some money or government some money, and they are guaranteeing me that I will get back my amount as a guarantee. Like they will pay back my amount whatever happens. So it's like private. So it is actually private between me and the lender, and this agreement between borrower versus lender. Okay, so bank is giving me FD, I am taking the FD. So I am the borrower here, bank is the lender here. Okay, so borrower is type of one of the fixed income. Now let's learn about bonds. So bonds are like or fixed income securities which are standardized. So there is loans, there is bonds, they are standardized tradable securities representing a debt investments. Standardized means it's like it's legally you can trade with that. Like if I have a bond, I can purchase and I can sell too in the secondary market. Okay, so this is like upper say the content is there. It's not the first paragraph is not going to the debt. So first paragraph is all about fixed income includes loans and bonds. That's all. It's standardized. It is tradable securities too. Now investors in bond are lending capital referred to principal, par or face value. Like I am issuing a bond of 100 rupees. Okay, so principal is 100 rupees is at par. Now, if I am issuing a bond at 80 rupees and will redeem you at 100 rupees. So 80 rupees is the discount here. And if you are purchasing the bond at 80 rupees and you are redeeming at 120 rupees, you are getting a premium here. Okay, understood? Yeah. So discount and premium was not there. I just went into the depth. So it is actually referred to as principal, par value, face value, etc. So if the bond is issued at 100, the principal, par value, face value is 100. Okay, so this is that lending capital is we will in fixed income terms we will say as principal, par or face value. That's all. The issuer of the bond promises to pay this principal amount plus interest, typically in the form of regular period coupon. Now extra word is coming, coupon, that is stated as a percentage of par. That means very very simple topic. That means if I am taking a loan of like 100 rupees and I am assuring you that you will get 10% per year for 5 years. Now what is 100 into 10%? That is 10 rupees. So for 5 years you will get 10 rupees each, then 100 rupees I will give you. So that is actually principal plus extra interest. So capital now onwards from the first chapter we will term as par value or principal or face value. So I will give you principal plus interest. Now the 10% which I told you is now here coupon. The 10% is now here coupon rate. Okay, so this is very very simple. We just learning the terminologies here. We just learned principal, what is principal, what is coupon. So 10 rupees here coupon, and so see here 10 rupees is here coupon and 10% is here coupon rate. So simple, this much, everything clear. The capital raised, okay, is usually used to finance the long-term investments of the bond issuer. Okay, so the one of the corporate companies, say like Reliance, they wants to build a factory. So they are raising a capital of like 1 million. So the 1 million is the principal amount. They are telling you that they will give you 10% annually as an interest. So 10% is they quoting a percentage. The 10% is their coupon rate, and 1 million into 10%, whatever the amount you get is the coupon value. Simple. So this is actually so we are thinking in the perspective of not of the perspective of the person, but in the perspective of a company. So this is used to finance the long term investments. That much. Once the long term investments are met, so this will be like in a periodical term, 5 years, 10 years, 1 year, 50 years. Also after the long term investments are met, so according to the agreement, according to the condition, when you subscribe, you will get the redeemed value. For a corporate issuer, loans and bonds are classified as long term liabilities in the balance sheet. Okay, so these are long term liability in the perspective of the company. So if the company is raising some fund from the public, it's a liability for them that they have to owe it back. What is liability? The amount owed to outsiders. So this is why in the balance sheet, if you are making a balance sheet, this is asset, this is liability. So here, if you are raising the funds, so this is in the liability side, it will come as long term liability. So I hope that the two paragraphs are very much clear now. Now we are going to the LOS. What did the LOS ask? We asked that we want to learn about key features. Okay, now we are learning about key features that are specified in the fixed income security, what the CFA Institute want you to learn which will be texted in the exam. So till now we had studied what is principal and what is coupon, that much. And now just we have learned about fixed income. That the types are loans and bonds. That's much only was in your syllabus. Now let's move ahead. What is in your key features? One of the key features is who is issuer, what is maturity, what is principal. Okay, so these are the terminology terms we will be learning in the first chapter. So who is the issuer? So basically if I tell you who is the issuer, this is very simple. Like Reliance Capital, Reliance Industry wants to raise 10 million. They are asking from the public. Okay, so who is the issuer of, they are issuing bonds, corporate bonds. Okay, so Reliance Industry is the issuer here. This much. Who is raising the loan? They are the issuer. Now let's dig into the Schwesers. Major issuers of bonds are sovereign national governments. We are coming into the types. Not only Reliance can be the issuer, so it can be sovereign national government and corporations. Okay, other issuers include local governments can also be an issuer. Supranational entities, that is International Monetary Fund, quasi-government entities sponsored by the government, that is National Railways, and special purpose entities, which are corporations set us to purchase financial assets and issue asset-backed securities, which are bonds backed by cash flows from those assets. So we are not learning here who are the issuer, what that I told you, that is an like a very basic term. So we are only learning the types. Who can be an issuer? Okay, so issuer can be, who can be an issuer? Supranational government, a sovereign national government. Next, corporation. Okay, corporation can be. Now there are others. So there are only two types: sovereign national government and corporation. Let's all come into the others category. So who all come in the others? Local government. So you can write with me: local government, supranational entity. What is supranational entity? So we are all tested in MCQ terms. International Monetary Fund. Okay, so these are supranational entities. Quasi-government entity, sponsored by the government, that is National Railways. Okay, so government actually sponsors them. And special purpose entity, which are corporations set up to purchase financial asset. Okay, and issue asset-backed security, that we will be learning in the next few chapters coming, and less subjects coming in depth. So we don't want to go in depth. Okay, so we just want to learn the issuer types. Who are all the issuer? Supranational government, corporation. Rest are the others: local government and quasi-government, supranational entities, and special purpose entities. Okay, and special purpose entities. That's much all. Okay, so these are the issuer. So these are the major types of issuers. Now let's come to majority. Maturity. So maturity means, if I am taking a loan from you and I am telling that this bond, I'm giving you a bond, and that certificate what you hold, certificate will be expired in like 5 years, and you will get all the fund. That's a deal agreement between us, and the agreement is going to close by 5 years, and I will settle all back the fund. So the n number, the number of years is the maturity here. The maturity date of a bond is the date on which a final cash flow is to be paid. Okay, so Reliance is taking a fund of 10 million from the public, and they are telling that it's a 5 years bond. So by 5th year everything needs to be settled. Okay, so final cash flow is to be paid. Okay, once a bond has been issued, a time remaining until maturity is referred to as the tenure of the bond. So it's a terminology. This is a 10-year bond, means its tenure of the bond is 10 years. That much only is the terminology here. Bonds with original maturities. with their tenure when they were first issued of 1 year or less are referred to as money market security. Bond with original maturity of more than 1 year are known as capital market. So in the now we are duration or maturity. Okay, now if like it's 1 year or more than 1 year, if it's 1 year it's like money market securities. If it's more than 1 year, it's capital market securities. If your stock market, everything will go under capital market securities. And treasuries, commercial papers, everything comes under, which is settled in just 1 year. Within 1 year it's all under money market securities. So it is the like types here. Now bonds that have no stated maturity, that are perpetual bonds. Like you give me cash and there is no maturity, I will give you 10% every year. Okay, so these are perpetual bonds. So these are actually secondary. So you can after you feel that okay, I'm done with this, I got a better investment opportunity, you can actually sell to another one seller. You can find one by this is why they are known as standardized. You can sell it on exchange and you can move to another. So this is known as perpetual bonds. So this is perpetual bonds, mean one which have no maturity. Now we are moving to next term, principal. What is principal? The par value of a bond is the principal amount that will be repaid. Repayment of principal typically incurs at maturity. Okay, so you are raising a 10 million capital. So we are moving to like principal. What is principal? Par value, face value we learned. Whatever the capital amount is the principal. So that is only the par value, face value and the principal. Par value of a bond is the principal amount that will be repaid. Okay, you are actually raising a debt of 10 million. Now you have to pay back. So that is actually the principal, or that is only the principal. Repayment of principal typically occurs at maturity. Typically, if I take 10 million from you, every year I will, for it's like tenor. Now I am using the terminology. It's tenor is 5 years. For 4 years I will pay you like a coupon rate of 10%. Now I think that you are familiar with the jargons here, terminology which I am using. So every year I will pay you 10% for 4 years, and 5th year I will settle full 10% plus the principal. Okay, so this is what here what is here written. Repayment of principal typically occurs at maturity. So at the maturity you will get the full, but debt instrument may specify that principal is paid back gradually over the life of the instrument, such as with mortgage loan. So it depends. So we will come into types of loan. So there are multiple options. I can pay you just the coupon rate, not the principal, and the principal at the last. But I can pay you the coupon rate, coupon amount, plus somewhat the part of principal also. So there are multiple options. Now we are coming on coupon rate and frequency. The coupon rate on a bond is the annual percentage of its par value. So we are raising 10 million here, that is par value. Now I will give you 10% per year, that is the coupon rate. Okay, and that will be paid to bondholder. Some bonds make coupon interest payments annually, while others make semi-annual, quarterly or monthly payment. Means this 10% can be annually, semi or quarterly. Simple. So every quarter I will give you 10%, every 6 months I will give you 10%, or every year I will give you 10% according to the agreement, borrower and the lender. So that was only the written. Now in a small paragraph there is somewhat additional knowledge given, information given. So let's cover that also line by line. Some bonds pay coupon based on variable market rate of interest at the date of coupon payment. These bonds are called floating rate notes or floaters. The variable market rate of interest is called market reference rate. Okay, so what we are learning here, some bonds pay coupon based on their, so we are learning about type of coupon here. Okay, coupon is actually either fixed or variable. Fixed means every year I will give you 10%. There is regardless of the market condition. But some markets are horrible, some markets are very bullish. So what can I do is I can leave the interest rate to according to the market. So some bonds may pay coupon was based on variable market rate of interest at the date of coupon payment. So every year on 31st March I will give you the coupon amount. Now coupon amount can be fixed or either variable. At the date of payment I can rely on any external factor. I can rely on variable rate of interest. Those bonds are called floating rate notes. Okay, so what are the bonds called? FRN, floating rate notes or floaters. The variable market rate of interest is called market reference rate. So these bonds use what's MRN. Let me be very clear. Every year on 31st December, I am issuing two bonds. One is fixed bond, one is variable bond. Every year for the first guy, I am paying 10% interest regardless of the market situation. But for the second guy, it's like up and down. I am issuing an FRN, floating rate note, to him. Now, the variable interest rate, I am giving a jargon to it. It is known as market reference rate. Okay, so practically there is LIBOR, SOFR, so etc. So I will, according to my scenario, I will look into one of these interest rate and I will decide what to give. And an FRN promises to pay the variable interest rate plus a fixed margin. Means the variable fixed margin can go high, it may go very low. So variable have to give fixed plus variable. Okay, so here what I am giving is I am telling that 2% is fixed, rest all according to MRN. Like if SOFR is 5%, like SOFR is like 5%, and I am giving you fixed 2%, so total 7% you will get. Okay, so this is what I meant to say. Okay, now this added margin is typically expressed in basis point, which are hundreds of 1%. Okay, so like MRN is like 5%, and I am adding 25 BPS to it. What is 25 BPS? 0.25%. Okay, so 0.25% for plus 5%, I will give you 5.25. So 25 BPS means 0.25, 50 BPS means 0.5, 75 BPS means 0.75. Okay, so this is expressed in basis point, the increment amount. Okay, 2%. So this added margin, it's specifically told that it's added margin is typically expressed in basis point, which are hundreds of 1%. So what did we here learn? We learned about coupon. Coupon has two, fixed and variable. Fixed, like I will give you 10% every year. Now if I am giving the variable, that bond is known as FRN, floating rate notes or floater. Now floating rate notes have two things. Fixed, I have to give fixed plus variable. Now this variable I will refer to MRN, market reference rate, like SOFR, LIBOR, etc. Now the added margin is referred in BPS. That much only is in the first point. Now what is the second paragraph includes? Some bonds pay no interest before maturity and are called zero coupon bonds. Okay, now let me show you a diagram here. Okay, now you took a loan, you took a bond here. Okay, you are giving your cash, like you give 1,000 rupees to government, bond, company, etc., and you are getting a bond certificate. Now you gave 100 here. Okay, now their tenor is 5 years. 1, 2, 3, 4, 5. So 1, 2, 3, 4, 5. Now what is written? Some bonds pay no interest before maturity. So maturity is when? 5th year. So you at the 4 years you will get no interest. So these type of bond is known as zero coupon. Write in your notebook. Zero coupon bonds or pure discount bonds. So what is zero coupon bond? Which pays no interest in the tenor and full principal plus interest in the final year. So pure discount refers to the fact that these bonds are sold at a discount to their par value. Like I said, it's a 100 rupees bond, but I am issuing it at 80 rupees, for example. So 80 rupees is the discount here, but at the redemption, at the 5th year, I will get 100 plus interest. So they are sold at a discount to their par value, and the interest is all paid at maturity when bondholders receive the par value. A 10-year 1000 rupees coupon bond yielding 7% would sell them a bit more than 500 initially and pay 1000 at maturity. It's just an example. In our reading fixed income bond valuation, so another chapter is coming. We will show how to calculate the exact price. So calculations are coming in the ahead chapters. Now another feature is seniority. Okay, so seniority means in the event of bankruptcy or liquidation of an issuer. So like a company ABC, okay, have issued a bond, okay, and issued a bond. Now they are liquid. They are now ABC have raised from public. Okay, I'm giving an example of from. Now ABC, what is ABC? Fall down. It's actually liquidated, bankruptcy. Now investors claim on the issuer assets rank above those of the equity assets. So preference holders have a more priority than the equity assets. So these bond holders are what? Preference shareholder. They will get first claim from the ABC than the equity shareholders, making debt senior to equity. Okay, so their debt is senior to equity shareholders. However, not all debt claims rank equally. Okay, senior debt rank higher than junior debt, also called subordinated debt, making senior debt a less risky investment from a credit risk perspective. So what they are telling, if ABC is bankrupted, first who will get? So first senior debt holders will get, then subordinate debt holders will get, then only equity shareholders will get. Understood? So this was all the seniority part. Now coming into the contingency provision, a bond may have an embedded option such as call option, put option, or the right to convert the debt into equity. Okay, so we will be learning in depth in another chapters. So just have a glimpse. A bond may have an embedded option, so it have a feature, extra feature you can add into that bond, such as call option, put option, or the right to convert the debt into equity. We will describe the option in later reading. Means I can call back or I can convert it into equity. So I can add extra features according to the agreement when I issue. So this is what is contingency provision. So these were the features. Any doubt? I think everything is crystal clear. I'm going line by line. Now let's move to the another topic, that is yield measure. Given a bond price and its expected cash flow. Okay, if a bond price is like 100 and every its coupon rate is 10%, that means every year you are getting 10 as the coupon amount. We can calculate the expected return from investing in the bond, referred to as the bond's yield. So what is bond's yield? Expected return from investing in the bond, that is bond's yield. For a fixed coupon bond, when prices fall, okay, so the price, what is the price? 100 rupees is the price. The bond offers a higher yield. So I will give you an example. If you are purchasing a bond of 100, par value 100, it may yield another coupon rate. Like it may yield you 5%, 6%, 7%, etc. Now, as the price, there's an inverse relationship. When the price falls, yield rises. When the price rises, yield falls. That's the inverse relationship here mentioned. For a fixed coupon bond, when price falls, the bonds offer a high yield to what? To attract the bond. So this is why the junk bonds and all have an higher yield, because you are taking much risk. When you are taking much risk, you should be compensated by a higher yield, right? When you are not taking higher risk, why you should be given a higher interest? Okay, if you are if like you have two options, you can invest in a treasury of US government, or you can invest in a corporate bond of a falling company. Now, investing in a treasury company in US government is very very safe, but investing in a falling company, if issuing debt means they are raising funds, so you are believing them that they will rise, so you are taking very very huge risk. So you should be compensated with more interest, that is yield, that is expected returns from investing in the bond. So this is why the inverse relationship is happening. So we will be performing yield calculation in the later reading. So professor's note also we are covering. The inverse yield relationship for a fixed coupon bond is crucial concept that runs through the whole fixed income topic. So a full subject we are going with this base topic only. If a bond with fixed cash flow is to offer a higher return, the only way this is possible is through investors paying a lower price for the bond today. If something has a higher return, if you are getting a higher return, it means if you are taking more risk, so the price will be actually low. Why the price will be actually low? Because so there will be some problem. You can understand. Hence, increasing bond yield implies decreasing bond price, and decreasing bond yield implies increasing bond price. So this goes on always opposite. For a given issuer, we will likely find that bonds of different maturity will offer different yield. A graphical plot of these yields maturity is referred to as a yield curve. So there is an yield curve there. There is just a graphical representation. So if you are plotting a US Treasury yield curve and all, so this is not an exam point of view that relevant. So an upward sloping yield curve, as Treasury exhibited in mid 2018, so they are giving you real life example, is referred to a normal yield curve, because this is shape most frequently observed. A normal yield curve reflects investors' demand for higher returns for longer dated maturity due to higher levels of uncertainty over long time frames. So I will give you one note. What is normal yield? So 2 year is there, 5 year is there, 10 year is there. Okay, 2 year you are getting 2%, 5 year is actually giving 3%, 10 year is actually giving 4% rate of yield. So why 10 year is actually having more, giving more yield? Because it is having more risk, more uncertain. Our very close, like 2 years is very very certain and we can predict, yeah, okay, actually okay, but after 10 years who knows what will happen to market. So we are actually taking more risk, so we should be compensated by more yield. So this is what is written here. So this is actually normal. So how will be the graph goes? Upward sloping. Yeah, it is written like that only, upward sloping yield curve. Okay, so that is normal yield curve reflect longer dated maturity will have higher level of uncertainty. Downward sloping curve, okay, exhibited in 2023. In the black line you can see here. So first we were having, in 1 month it was high, like it was like 5 to 6, 5 to 6 range between, and in 30 year it is having 4, So it is coming from 5.5 to 4, right? So in 2023, that's why that is why Bitcoin fall to like 16,000, and US markets and all had a dip of like 5 to 10%. Okay, so it is known as inverted yield curve. Inverted yield curve is the first indicator which actually points out a recession. Okay, so this was only the paragraph, much interesting, and they told that it will be covered in full entire syllabus of the fixed income. Government's bond are often deemed to be the lowest credit risk. Why? There is much safety. There is no need that you should be compensated by a higher yield. There is no risk. So there is low credit risk, high credit quality in a particular market due to the fact that the bonds are backed by the tax raising powers of the government. Why there is very much safety? Government can just raise tax and pay back your loan, right? Government bond yield curve is commonly used as a benchmark to access the extra return called spreads. Now we are coming to an extra concept. What is spread? So here it is only written benchmark to access the extra return. Okay, so if your corporate bond is giving you 7% yield and the government bond is giving you 5% yield, 7 minus 5, what is the difference? 2. So 2 is the spread here. For example, so let's read. A 5-year corporate bond were yielding 6%. So corporate bond is much risky. Company can anytime shut down. So it is yielding 6%, and 5-year government bond were yielding 5%. Okay, so 6 minus 5, 1% is the spread here. So this was the just first LOS. We have gone in very much depth. I think everything is very much clear to you. Now we are going to the second LOS here. What is the second LOS? Describe the contents. So describe the contents of bond indenture. Okay, and contrast affirmative and negative covenants. I know it may sound harsh to you. What is this indenture and affirmative and all? Let's go line by line again. So the legal contract between the bond issuer. So what is that? Legal contract between the bond issuer and the lenders, bond holders, is called the bond indenture. Suppose Reliance is actually raising the loan. Okay, Reliance is actually raising the loan. Now they are getting into an agreement. So they are telling that everyone is giving me 1 lakh or 5 lakh or 10 lakh. The bond actually are traded only in lakhs. Let's say 10 lakhs. Everybody is giving 10 lakhs, and annual coupon rate is 10%. So every year you will get 1 lakh. Now there should be legal agreement, right? So this legal agreement is known as bond indenture. So basically it's an agreement. That's all. This actually the legal agreement between the borrower and the lenders is known as bond indenture. The indenture defines obligations and restrictions on the borrower, including the source of repayment, and form the basis for all future interaction between the bondholder and the issuer. So in the bond indenture, everything will be written. So it's like bond indenture, everything will be written. Restrictions, forms of payment, everything. Now let's come to source of repayment. The source of the cash flow required to be paid by the bond issuer depends on the nature of the issuer and the types of bond issue. So it's actually depends on the type. Okay, sovereign. So in the issuer we have learnt multiple issuers are there. So how will they repay the bond? If they have took a big bonds raising are not in thousands, not say they are in very much lakhs or crores and millions. Now we want a surety. How, if the default, how will they repay? That's an interesting topic. Sovereign bonds, national government, are repaid from taxes. We are on this point for the second time in this chapter. They can just raise the tax and pay back you on economic activity, and in some cases the ability of a government to create a new currency. Like they can just print the notes and pay back your loans. So there are two options for them: taxes and create new currency. This tends to result in sovereign debt being perceived as the lowest credit risk in a particular region. Now tell me, the yield will be high or low for this? Low. Because you are having a very much safety, the taxes can be raised, new currency can be issued. Means the currency already existing will be printed more. Local government bonds are repaid from local government taxes or revenue from operational infrastructure such as toll roads. Now another issuer, who is another issuer? Local government. So they are repaid from local government taxes, okay, or revenue from operational infrastructure such as toll roads. Suppose India is not taking loan. Suppose a state like Kerala, they are raising bond. Suppose when Russia-Ukraine war happened, actually Ukraine raised loan from the international boundaries. Now if Kerala wants a bond, so Kerala can issue a bond. Now what is the so these are actually repaid by taxes from the Kerala people and from operational, from infrastructure such as toll roads, everything, whatever the revenue Kerala government is receiving from the Keralites, from the Malayalis, from the people residing there, so they can just pay back the loan. Now corporate bond, so it actually depends on the type. Secured bond is repaid from the operating cash flow of the company. So if like Tesla is raising a bond, so Tesla is selling cars, they are raising revenue, so they are getting revenue, so it can be repaid from that. Secured bond with the added security of a legal claim called a lien or pledge. Means there is a mobile, I am selling to you, you are taking on an installment. Now if your installment breaks, I will just lien the mobile, I will just hold the mobile with me, I will not give to you, it's under my custody until you pay back the amount. That's called lien. Now with the added security of a legal claim on a specific assets of the company is referred to as collateral in the event of issuer default. Like Tesla is issuing 100 million worth of bond. Now if the company, how the company will repay? They will just sell cars and give back to you. Now if for a secure bond, Tesla will keep a collateral, like 100 million cars is on my collateral. If I default, you can take away the cars which Tesla as a company has kept as a collateral. In the contrast of an unsecured bond, which having no such claim is repaid only from the operating cash flow of the issuing company. Means if you have subscribed to an unsecured bond, if Tesla is generating revenue, it's okay, you will get back the amount. If Tesla is not generating any revenue, you cannot claim on the Tesla assets kept as the collateral. So when you are taking a corporate bond, you have to always take secured bond only, then only you can actually lien their assets. I am holding your cars, now give the amount, then I will give the car back to you, or the car is mine. That's the policy here. For an asset backed securities, the financial assets held by the special purpose entity that has issued the ABS provide the cash flow promised to the ABS investor. We will discuss this in more details in later reading. Okay, so I am not covering this part because this will be covered in later reading. It's a high mechanical concept, so very much basic has to be covered if I have to tell this. Okay, it's basically that if like 3 houses are there, 3 houses, all of them are paying loans on their mortgages. So I'm talking about MBS here. So this MBS is issued by like Kotak Mahindra Bank. Now Kotak Mahindra Bank is selling these mortgages to another company. So every year, whomsoever purchases the mortgage backed loans, MBS, will get a fixed percentage of interest. So this is only written, but we will be covering the later reading. Bond covenants. Now it's the other point, bond covenants here. So it's all we learned about type of issuers. What is bond indenture we learned in the second LOS. We learned about the sources of repayments in national, local and government. Now what is bond covenant? While debt investment do not provide voting rights in the same way as an equity investment, certain legal rules known as covenants can be written into the bond indenture. Okay. So while debt investment do not provide voting rights in the company as an equity investments. So debt holders have an preferential right over the equity, but voting rights are with equity shareholders. Certain legal rules known as covenants can be written into the bond indenture. So once you are getting to an agreement, you will get the preferential right but no voting right, but you can have covenants in the bond indenture so that it's more to like customized. So what is affirmative covenants and what is negative covenants? Affirmative covenants means specify requirements that the issuer must fulfill. So when the bond holders and the issuer get into a contract, in the bond indenture itself, you write the affirmative covenants, what must the requirements the issuer must fulfill. These may require the issuer to provide timely financial report to bond holders, specify the use of proceeds from the bond issue, or specify bondholders' right to redeem at a premium to par if the issuer is required in the merger. Whatsoever your requirement is, that all you can write in the affirmative covenants. Two examples of affirmative covenants are cross default and pari passu provisions. These are just examples. Now just dig into it. What are they? A cross default states that if the issuer defaults on any other debt obligation, the issuer will also be considered in default of this bond. So there are 10 covenants written, requirements written. Even one is failed, everything is failed. That is cross default. Pari passu means bond will have the same priority of the issuer's other senior debt issues. Bond will have the same priority of claims as the issuer's other senior debt issues. So it is considered as equal and it will be having senior debt considerations too. Now what is known as negative covenants? So affirmative covenants is you just in the bond indenture you just specify what the issuer must fulfill, requirements are. Now let's go on to negative covenants. So we are almost moving into end topic, I guess. So there are just some module quizzes and we have just wandered up. Okay, so it's the last concept of this chapter. So negative covenants means places restriction. Affirmative covenants means you are writing the requirements. Now negative covenants means places restriction on the issuer. So these can include restrictions on entering into asset sales and leaseback agreements, pledge of collateral and issuance of debt more senior than existing debt, additional borrowing, share purchase or dividend payments. So they are giving you examples, not to go into much depth. It's just restriction on the issuer. Negative covenants protect the investors of bond holders, what not be done, and prevent the issuing firm from taking action that could decrease the risk of default. However, covenants must not be so restrictive that they prevent the firm from taking advantage of opportunities or responding appropriately to change business circumstances. Changing business circumstances. So one company is issuing some loan as bonds. So you don't have voting rights. So in the bond indenture you write everything, what must be fulfilled, what must not be done. That are affirmative and negative. So this was the end to the first chapter here. So just let's revise it, what all we have learned as a key concept. Okay, so there were just two LOS. So there were we learned about basic futures here. So we learned the basic futures. So basic futures, there were issuers and there were maturity. Who are the issuers? Corporation, government, quasi-government entity, supranational entity, special purpose entity. Bonds with special original maturity. So bonds with original maturity of 1 year or less are money market security. Bonds with maturity of more than 1 year are capital market security. And we also learned perpetual bonds which have no maturity. Par value is the new terminology we learned. It's face value, or this actually it's capital. Capital is known as par value or the principal amount or face value. Coupon rate, if you are raising 100 rupees and every year I will give you 10 percentage, that means you will get 10 rupees, 10% is the coupon rate, 10 rupees is the coupon amount. Senior debt ranks about junior debt, means preference shareholders are settled first than equity shareholders. We have learned in our previous prior educations. Then we are learning an additional steps in the debt. Senior debt is there, junior debt is there. Junior debt is also known as subordinated debt. When or junior debt. So when the firm goes into liquidation, so there could have some contingency provisions too. Now we learned about source of so what we also studied about yield. What is actually yield? So yield is basically what? Expected return from a bond. So we also learned there is a concept which will be continued in the whole syllabus. Inverse relationship between price and a bond. Price goes low, yield goes up because you are taking more risk. Now we learned about sources of repayment. National governments actually repay by tax and issuing more currency. Local governments actually raise more money by revenue and taxes. And corporate, we learned about secured bonds, unsecured bond. Secured bond, if you are taking, you can have a lien on their assets, say, and from their revenue. If you are taking an unsecured corporate bond, you can only have a claim of the whatever the revenue is. If there is no revenue, you can have no lien on their asset. What is lien? You just take back their asset and blaming and just blackmailing them. Give back my money, then I will give back your possession. You give a property. I just gave you the mobile phone example. Then we came into LOSB. There we learned about bond indenture. That is just a legal agreement between bondholders and lenders. Now it may be affirmative or negative. Affirmative means what should be done. Negative means what should not be done. So here we are coming and end to the first chapter. Hope it is very much clear to you. Now in the further videos we will also try to do Schwesers questions, curriculums questions, blue box questions, and I will also try to do the practice kit which is included in the CFA site. And if anything extra questions comes into my mind or in my resources, I will also share here in front of you in the same class only. So hope you like this class. So thank you.